can you think of anything else that people should be looking at?
Yeah, you mentioned those short-term benefits.
Yeah.
Like it's like I kind of laugh at it's like the ones where like if you get your arm cut off, you know, the
Yes.
accidental death and disability
Yeah.
coverage. And you had asked earlier in the podcast what you thought, what I thought about
Yeah.
that. And I kind of agree with you. If you're paycheck to paycheck, you may want some of that stuff. But if you have a proper financial plan and you have enough liquidity and savings and retirement assets, you know, you're not buying insurance for the things that cost you, you know, $10,000 or $20,000 or even $50,000. You're buying insurance for the $1 million.
Yeah, the catastrophic
stuff. So really, when we think about, you know, okay, would you like an extra $50,000 if you got cancer? I'm not saying that that's bad, and you can elect it if you want, but that won't. If that is the deciding factor between your financial success or not, you know, there's probably bigger conversations to be having.
Yeah. So, all right. Well, lots changed since our last episode, Brent.
I think you had Matt on, if I recall, right? Because I was preoccupied.
Yeah. I don't think your absence didn't come with a good excuse, frankly. I mean, you know, back in the old days, you know, your wife would just give birth and you would continue to go to work. At least that's what my father would tell me.
Oh my gosh. Well, I kind of feel the pain of that in the sense that, like, running your own practice, you know, the like you got to keep the wheels turning, so to speak. So here I am in the hospital with my wife, and I had planned on, like, I don't want to say working in the hospital, but just like having access to internet.
Yes.
And the hospital internet was horrible. It was funny because overnight the internet would work. So like starting at like 9-10 p.m., somebody flipped like a switch or something and the internet would work and I could communicate with the outside world. I could like send texts and all this stuff. And then come like 8-9 o'clock in the morning, it was like a light switch shut off and all of a sudden nothing worked. And so I was kind of.
So they shut off the internet?
No, look, I am not a technical person, so I don't know exactly, but like internet was on, like guest Wi-Fi is on.
Yeah.
But I'm on the guest Wi-Fi trying to go to a web page and I'm just sitting there watching it spin for 20 minutes.
The spinning wheel of wasted time.
I basically, and of course, like we're not, of course, I'm not accessing client stuff on the public Wi-Fi, right? So we all have, you know, personal hotspots and things like that to solve it. But then my phone couldn't get any data. So it's just like basically being in this concrete jungle of a hospital. It just wasn't very conducive for working. So of course, back to your point.
Nothing to do. So you couldn't get any work done because of the fact of, you know, your wife having delivery pains, you know.
Well, no, she was, and look, I don't want to give the impression that like spending all the time working. Actually, I did no work.
Yeah.
But in our position, it is really nice to at least be able to communicate with the outside world if they have an email or a text or a question. And that was, I was kind of offline for a couple of days, which was an eerie feeling. So
for those of you who don't know Brent, like I know Brent, he is what I would call a high communicator. So it is very unusual to not be able to get in touch with Brent for a couple of days. And I have to say, I didn't talk to you or chat with you for a couple of days. And it felt a little different.
Dude, it's been a tricky transition. I mean, we now have 3 kiddos. We have a 6-year-old, 4-year-old and a newborn. And newborn is great. Like she's really well behaved. And my wife and I feel like we've kind of done this before. So we kind of have the hang of it.
Yeah.
The other 2 kids, I don't know if they were this hyperactive and crazy before the new baby was born, or they've taken it to a new level. But the level of craziness in my house the last couple of weeks is off the charts.
Well, I would imagine they're competing for attention.
That's what I think is going on. Yeah.
So, well, that's exciting. I'm really thrilled for you. Having another Gargano in the world is definitely a positive. So, thrilled to have your new daughter and have you back in play. one thing that I remember about all 4 of my wife's deliveries was, the hospital almost goes out of their way to keep you awake. They keep the lights on, you got the nurses constantly coming in and out. It's 4 in the freaking morning, and every 15 minutes, they're coming in to check in. It's like, when you have your 3rd child, you're like, "We got it," you get just go, but they continue to do it. So they treat every delivery like it's your 1st child, and that you have absolutely 0 clue, uh, what you're doing. So I remember, I don't know if this is the way it was for you, but I remember just not getting any sleep while at the hospital. So my advice to people is as soon as you feel ready to go, go. You get better sleep at home. Um, so that's an exciting change. Well, we got a lot of changes since our last episode. So, um, I personally have observed markets kind of continuing to inch higher to new all-time highs. It seems like everything's at all-time high except for crypto. So we had an interesting event happen in crypto where, what I'm really talking about is like Bitcoin. As goes Bitcoin, so goes usually the rest of the crypto markets. So we had a little panic a couple weeks ago. Wasn't this past Friday, but the Friday before, where China threatened to, you know, wean the United States off its rare earth mineral supplies. And of course, that's not a good thing, right? Because the United States depends on China for, I think, what is it, like 10 critical rare earth minerals, and 8 of them come from China, something
You
like
know
that.
better than me, but
So anyway, false alarm. So this announcement comes out that we're ratcheting up tariffs 100% on China because they can't do this, and how dare they? And then come Friday, like crypto markets just tank. What's interesting is that Bitcoin, there was specifically, I'll put up on the screen here. There was a Bitcoin trade that this guy, oh, here it is, Unusual Whales talked about. So there's this post here. It says, a new crypto account was opened yesterday morning. And this post was as of October 11th. This happened October 10th. 30 minutes before Trump's announced 100% tariffs in China, it added a multi-million-dollar levered Bitcoin short position. Then the market dumped. The trader made a profit, 192 million. So supposedly this wasn't the only insider trade. There was a lot of shenanigans going on. So there's some rumors that that a lot of this was like just market manipulation. That the whole crypto dump. I mean, it's not a widely traded market. A lot of people don't realize that Nvidia has a larger market cap than the entire Bitcoin market cap.
right.
It's not an insignificant difference.
Yeah,
It's like
smaller
$1 trillion
amounts of
difference.
dollars can make larger impacts.
Bingo. Yeah. So anyway, that happened. And of course, Bitcoin went from 126,000 all the way down to 106,000. Now it's floating around 111. So things seem to have settled down. But there's a lot of froth in the the zeitgeist right now about gold. Gold being at all-time highs. I get a lot of questions about that. We really won't touch on that today. I'll just say, everything's kind of all-time high, and it's like financializations of assets is a ongoing theme, and I think it'll continue.
Well,
Um,
ironically,
yeah.
just this morning, I received an email about mutual fund flows.
Yeah.
So one of the things that we pay attention to as advisors, and I agree with you, just seems like about everywhere you look right now, things are up, right?
Mhm.
Whether it be U.S. stocks, international stocks, gold, crypto, really all risk assets seem to be just ripping,
Yeah. The only thing
right?
that's not, if you look, is the US dollar. In fact, cash has been relative to the international basket of currencies, otherwise known as the DXY. The dollar relative to the DXY year to date is down over 8%, 8.8%. So, that's actually really helped out a lot of foreign stocks. So, for the first time in a long time, without the dollar devaluation, uh, foreign markets would actually be performing worse than U.S. markets. But that's not the case because, foreign equities, I mean, some of these funds are up 25% plus
Well, and
year to date.
ironically, I mean the volume,
Mhm.
the bubble talk
Mhm.
is like loud right now.
Oh, very loud.
I mean,
Mhm.
I can't turn on the TV or read the news without hearing talk of the assumed bubble that we're in. And I think what's what's interesting, so again, I got this email this morning, and it's about mutual fund flows. So as advisors, we track these things, right? Like we can actually see, is money flowing into certain types of mutual funds or coming out of
Mhm.
and it kind of informs us as to like what the average investor is doing with moving their money. And if we look historically, when you actually get to a market peak, what's happening to the fund flows? Like people are putting money into stock mutual funds when markets are at all-time highs. Like we know that
Mhm.
through data. What is interesting to me is that on a year-to-date basis, looking at this report, we've actually seen the most inflows. We've seen inflows into bond mutual funds
Mhm.
way up, like $400 billion into bond funds. And equity funds are actually having outflows.
Yeah.
So money is moving out of the stock funds into the bond funds in the midst of the market rallying. This is just the most, I know we kind of had a podcast on it this summer, and it's probably cliche because
Mhm.
what rally isn't hated, but like people hate this rally.
Oh, they do. Yeah. Yeah. They think it's too good. I got to put money on the sidelines. Yeah.
And markets don't normally peak when money is
Mhm.
flooding out
Well, here's
of stock
y-
funds.
granted, we do want to move on to the money story of the week, which is an exciting new segment we're going to have. So I will say this, and then we can move on. I think people just don't trust this rally because it's concentrated. It is concentrated in a few names. Like you take out the Mag 7 and the S&P is essentially flat for the year. And two, I think there is a general distrust of the benefits of AI. So right now, the common theme is that AI is out for your job. It's going to replace you. In fact, there are a lot of stories that I read recently. Amazon cut a bunch of its workers in AWS because they're outsourcing to AI. There was a story I read last night about what company was it? 343 Industries. It's a company behind Halo, Microsoft's video game. It's a popular video game, and I read an article where there was basically a mass exodus out of the studio because they're using AI to replace jobs. So there is some truth to that, but I think people they listen to that and they're like, "Oh, that's negative." And then there's this whole notion that AI really isn't profitable right now. OpenAI, the largest company in the space right now, is yet to turn a profit. So, what's the future for this? How are they going to grow into these valuations? And it seems like it's like what the analogy I always hear is what this is the new
Normal.
.com bubble. Yeah, .com bubble. Yeah, it is. But I do. You're listening to me. I say it's the new normal. But everybody's uh, drawing comparisons to 2000 to really 1998 to like 2001. And I don't think that the similarities are enough to draw that comparison. The my opinion with this whole AI thing, I do think that they're eventually going to grow into the valuations. The revenue model, the future for these companies is obviously advertising. It's the same path that Google took. Google used to be a very useful tool where you would go in and it would give you like authentic search results. Now, everybody still uses Google, but what does it deliver you now? The first like 20 things is sponsorship.
Yeah,
And
the
and
blue
even the
link
stuff that's
economy.
not sponsorship is still, it's gamification. People have gamified what's the term for it?
SEO.
SEO. So it doesn't give you like good search results. It gives you the search results that optimize for Alphabet. And that's the future of these things. And it's going to be it's going to be advertising bonanza.
Yeah, there was news that Walmart
Mhm.
partnered with ChatGPT, so
Yep.
you're going to be able to go like have AI shop for you,
Yep. Mhm.
and like I wonder, like if I'm Clorox,
Mhm.
like how much money do I pay Walmart to like make sure that if somebody says they want to buy a cleaner
A
and they don't like
lot. You
specify,
pay a lot of money
like it
is the
just buys my
answer.
Clorox
Yeah.
cleaner.
It's there's a significant bull case to be made here. And I think that the world is split between the optimists and the pessimists. And what you're seeing is most people are being very cautious. They're not like hopelessly optimistic, which is different than the dot-com bubble. Then the dot-com bubble, everybody was piling money in these tech
Well, and the
stocks.
truth is, when you have technological change
Mhm,
like this, the big players, they have
mhm,
to spend.
mhm.
I mean, you just, the price of not spending and falling behind is your whole business,
Yeah,
right? So, I mean, these businesses just have to spend first and figure out how to monetize later.
yeah.
And I do think, I mean, I don't think it's unreasonable to think that there's a chance that we are either in the beginnings of a bubble or a portion of the bubble. It's not unreasonable to think that we could get ahead of ourselves
Mhm.
in these things. It's just, I think as an advisor and as somebody that doesn't believe that market timing is an effective way to approach wealth creation over time, like getting out of the market now to say that I'm smart enough to know that this is close enough to the top that I'm going to be able to put my money back in
At a lower
at
point.
a lower price
Yeah.
later. Even if you look at the 1990s, I mean, you really, if you got out any sooner than like 1998,
Mhm.
I mean, you still were getting it at higher prices, even if you bought at the bottom
Yeah.
in
Yeah.
I mean, so when you look at like the couple of years leading up before the bubble, the returns are massive, right? And so, okay, yeah, you might get cut in half, but you might double first.
Sure. Yeah.
And it's just timing the market is just such a tough game because even if you're early, you could be right, but be early and still be wrong.
Yeah. Well, I think that's a great way to kind of cap off that whole discussion about current events. I think we should rewind the clock a little bit and talk about something that you encountered over this sabbatical. It's not a sabbatical. What do you call that? A maternity leave?
Maternity
Yeah,
leave, yeah. Paternity leave.
yeah. You're crushing
My
some
my
books.
new employer offers, the most robust benefits package I guess I've ever had, right?
Yeah, yeah.
So
Well, you are your own employer.
here I
But
am.
yeah, you got unlimited maternity leave. Wink, wink.
Paternity leave.
Oh, is it paternity? Yeah. Okay.
Paternity.
I don't know this stuff. I
Yeah,
didn't.
if you've never worked for a W-2, you were never in corporate America, were you?
For a brief period of time, but I never had paternity leave.
Oh yeah.
So my wife had two babies when I was working for in the corporate world, but they never gave me any time off. This notion of fathers getting paternity leave is new. Because back in see when was my second son born? I mean, he was born 2015. In 2015, it didn't exist.
Yeah. Well,
Yeah.
and this is prescient to the conversation today on employer benefits, but I
Yeah.
was fortunate enough to start my career at Fidelity,
Mhm.
and Fidelity Investments has, they have, they're a huge company and they're private, believe it or not. So they have, what's nice about being private company is you don't have to really meet investor expectations quarterly. So it
Mhm.
maybe gives them a little bit more ability to spend their money how they want,
Yeah,
right?
yeah.
And so their benefits package, I mean, I can't say enough good things. But yeah, we had, what was it? I think 6 weeks of paternity leave from Fidelity. I think the females, women had 3 months,
Yeah.
I believe, and it was all fully paid and no expectations of. The other nice thing about Fidelity is there's thousands of people that do your job, so there's somebody to, there's never something that it's like can't be done by somebody else, so you can really unplug.
Well, that's the way it should be because I think if you do anything less than that, you're just injecting unnecessary stress into your employee's life and then they become less effective.
Yeah, I mean, I really appreciated the benefits they gave us. We took a lot of time off at Fidelity, and then at UBS, it was a little bit different, but they still had. It was kind of interesting at UBS because you worked for a team, like a wealth management team that operated
Mhm.
as their own business, but they were kind of like a franchise of the bigger firm. So you had the larger firm that kind of had their like corporate policy, and everybody had to follow that per the rules, but at the same time you had these smaller teams that like maybe there weren't 10 people to do the same job, and so that you really had to, and if you wanted to take true leave, like there wasn't like, well, you can access your email periodically if you want. It's like, no, you're cut out of your email. You're not touching anything,
Hmm.
right? So it was this was much better because as you mentioned, I mean, I don't mind working at all. I just need to have access to my computer and phone, and
Yeah.
um so but gosh, I can't imagine being cut out of my email these days.
Yeah. Well, I like the idea of it. Because email is one of the most stressful things in my job. Because someone described this to me, and I believe this 100% is your email is the to-do list everybody else creates for you.
Yeah.
You have no control over it. So everybody else that just creates this giant to-do list, and it brings me a lot of anxiety because I can't really manage my day, and sometimes email gets to the point where I just can't stay on top of it, and it flows into the weekend. This past Saturday, I worked pretty much the whole Saturday because I literally just had so many emails that I had to follow up on. So the idea of ignoring my emails sounds fantastic, but the reality of it is, you might as well just like blow up your whole business or your professional life. You know, this it's funny. Yeah.
Well, there's just levels of priority, right?
Mhm.
And it's like I don't necessarily need to be tapped into my email for everything, but there are
Mhm.
certain things where if they come through to my email, I need to be able to see them, right?
Well, Microsoft has done this new update with Outlook where I've got this focus email category, and I have to say that's been incredibly useful. So it
Yeah.
weeds out all the minutia. But
Although sometimes you just miss emails completely
yeah,
because they go to the wrong box.
yeah. Well,
It's like the new. How is that
modern.
different than the junk, the spam folder of
It's
old?
different because a lot of the emails I get are automated emails, and they're not necessarily spam where I don't want them to go automatically to something I can't see. I do want to be aware of them, but they're almost like I just read the header. I just need to read the header. And then if it triggers like alarms in my head, I'll go in deeper. But these are emails I want to be aware of, but I don't necessarily need to go in depth into them. So a lot of times it's a quick glance and delete.
So
Quick
this
glance,
is a
delete.
good moment to promo both mine and Ben's newsletter.
Mhm.
I write a newsletter on a monthly basis, and so does Ben. And if you are not getting them, you're either not signed up or you might want to check your not focused email inbox.
Yeah, we put our new links to our newsletters to sign up in the show notes. So you can just check out the show notes and easily click our links and then sign up for the newsletter.
But kind of a joke about the focused inbox. I'm sure
Mhm.
our newsletters end up in the other
Oh, they
inbox.
definitely do. I know because I subscribe to my own newsletter.
And you could say like, oh, I could go check it. Do you ever actually go look through the other inbox?
Email is one of those things where it's tough to step away from, especially if your job is one of the only ones in the organization can do what you're doing. And that is true for you and I because a lot of times our clients don't want to work with someone else because the trust is with us. So it's really tough to step away for 2 weeks and then have that work properly delegated. So what happens is you get the snowball effect. So the work doesn't go away. It just builds up, and then you end up with this overload of tasks, of to-do tasks, when you come back from paternity leave or vacation. So I find it very difficult to kind of go on vacation and just truly shut your mind off. Not to mention vacations come with a whole stress. I'm not going to get in the whole vacation discussion. That my wife and I kind of disagree with that. I find them to be stressful. She enjoys them. But a lot of the reason I find vacations to be stressful is because I know in the back of my mind that work is just building up, building up, building up. So there's no escaping it. And email is kind of the manifestation of that work. So, as I said, it's the to-do task that everybody else builds up for you. So, but anyway, enough about that. We do want to talk a little bit deeper on employee benefits. So do you want to get into that a little bit?
Well, yeah, I was just, for clients that a lot of the clients that we're working with right about this time of the year is benefits enrollment,
Mhm.
and just having had a child, our third child, and this one, my first two kids, I was working at kind of corporate America, right? And
Yep.
so you had a very traditional health insurance policy and all of this stuff. And then of course now being self-employed, I have like a broker and we have this hodgepodge of medical plans that, kind of works out to be, the most cost effective, although it's a little convoluted. And I just, this time of the year is so relevant for like benefits discussion, right? So if you work for any large corporation, you either likely have your benefits enrollment open now, or it's going to open soon, or it was just open recently. And one of the things that we do on an annual basis with clients is we try to help them make sure their selections on these benefits are right. And I think, like, from my perspective and my experience as an advisor is like people, it's so funny, the job of an advisor, because you want to bring positive change to the client's life in terms of like saving them money, helping them be more intentional with the way that they use their money. You also like don't want to give them too much homework.
Yeah.
And so, and clients don't always quite understand like what the value is or isn't going to be. So like benefits is one of those things where I ask like, hey, have you looked at your benefits enrollment? And a lot of times people will say, oh yeah, we knocked that out. And what I have found is that when you take the time to slow down and go through the benefits, like let's say you have a couple with a kid or a couple of kids, really looking at not just the medical plan, but then also like what other benefits does the company offer? Are those benefits priced well? Do those benefits have the right kind of coverages and choices for you, right? And then making intentional selections and hopefully getting a more robust saving strategy and risk management while having I'll say the right amount of money coming out of your paycheck.
Yeah. So, what's a good starting place for benefits enrollment? I would say really having a financial plan in place is a good starting place, and that's something you kind of want to have prepared going into open enrollment season, which is what do you typically see, like October through December? Or is it normally? I normally think of open enrollment as like November, December, but you know,
I mean, it's a little all over the charts. I have
yeah.
one company I work with that does their benefits enrollment in May, of all times, and that can be a little tricky if you have one spouse that's their enrollment's in November and another spouse where their enrollment's in May, because you kind of double up. But yeah, most of the time October to December.
Yeah. So you start with a financial plan, and that kind of helps inform what benefits you should be enrolling, which ones you shouldn't. But if let's assume you don't have that in place, you're just shooting from the hip, which most people do. What are some absolute no-brainer things people should be enrolling in if your employer offers it?
Well, I'll say the one that's really relevant for a lot of the people I'm in my mid 30s. A lot of the clients that we work with they always say most of your clients are plus or minus 10 years your age.
Mm-hmm.
Recently, actually, with the most recent tax bill,
Mm-hmm.
the OB3, as I think we're calling it, there was an expansion to the dependent care FSA.
Yes.
So this is the account where you can set aside money pre-tax and use it tax-free to pay for daycare and like early childhood expenses.
Yes.
And I have a lot of clients that we work with that have young kids at home and are spending money for nannies, childcare, whatever, daycares, preschools, things like that. Used to be the limit on this account was $5,000, and it's kind of a use it and then get reimbursed for it. So you put the $5,000 in, you have a bill from the daycare or whatever it is, and you get the $5,000 out. For my whole career, people have been cynical about that $5,000 because of the cost of childcare.
Yeah, it's hilariously more expensive than that.
Yeah, like I think the last time I was paying for daycare, it was like $1,600 a kid.
Yeah.
Or something like that per month.
Per month, yeah.
Right. So then you have two kids or whatever. I mean, you're spending like $30,000 a year, and they're like giving you a $5,000 aid. So they've upped that limit to $7,500. So you get a little bit more room in there. I think if you have kids and you're spending that money anyway, that's a no-brainer. I think certain things like the legal coverage, that one can be if you don't have an estate plan, the legal coverage is kind of often overlooked in there. It's normally like $5 to $7 a paycheck, and it doesn't.
That's a heck of a deal.
Yeah, and that's the thing. It doesn't cover, like, I've actually had experience with clients using this and whatnot. They won't cover like complicated legal issues. So don't buy your legal insurance and expect that if you get into some big lawsuit that you're going to get covered for it.
Yeah.
But it'll cover some basic things. So like where we use it as advisors is, let's say you have a client that hasn't done their estate plan, and typically an attorney will charge something like $2,000 to $3,000 to put together kind of a basic estate plan with a trust and a will and the powers of attorney and so on. if you have the legal insurance, a lot of times that cost comes down to like well under $1,000 out of
Yeah,
pocket
it's
for you.
worth $5 a pay period.
And you can turn that on and off, right? So
Mhm.
one year you could turn it on, then you can turn it off the next. And
Yep.
and I could keep going down the list. Some of the ones that are less, well, maybe let me put the question back on you. What are
Mhm.
other expenses what are other things in your benefits enrollment that you see as no-brainers?
Long-term disability. It's something few people enroll in that you would be crazy not to. Long-term disability. I'm not talking about the Affleck stuff. In fact, I'd like to get your opinion on that. I personally don't advise it, but if you have an emergency fund, you don't need that sort of thing, and it's not commonly used. Although there was one exception to this, there was one short-term disability policy for one client that I reviewed where that actually paid for uh, uh, delivery costs.
Right.
It considered pregnancy short-term
Yeah, so you
disability.
can kind of game the system a little
Yeah,
bit.
so
If you knew you were going to have a kid.
yes, and actually they considered having a baby to be a disability, which
Right.
I thought was like, wow, that's kind of silly. Why would they insure that? But that sure enough, they did, and they were able to collect short-term disability for like 6 months on
Yeah.
this, which was really kind of nice. Like, why wouldn't you do that? But that's a bit unusual. So barring that, I don't generally suggest these short-term disability policies. The risk that everybody needs to ensure that nobody really pays attention to is long-term disability. So everybody knows that death is a possibility.
Yeah, death's a scary thing.
Yeah, the wisdom behind buying death insurance, which is really we call it life insurance to sugarcoat it, but the wisdom of buying that type of insurance on a life, especially the life of the breadwinner, is like just commonly understood. Like, oh yeah, of course it's a good idea, but then nobody considers the notion that it's more common for people to be disabled long term. So like if you're a dentist by trade and you're in a car accident and the airbag blows your hands to smithereens and now you don't have that fine motor movement skill and you can't be a dentist anymore. Well, what do you do now? Your income's just cut in half or more.
And
Yeah.
statistically, and like I think your example is obviously a little bit of hyperbole, but the
Mhm.
reality about disability is it's not a lot of times getting like your hands blown off. It's
Well, I didn't mean blown. I meant just hurt.
no, but it's not even like major injuries a lot of the time. It can
Mhm.
be you have chronic headaches, and you get migraines, and you can't work when you get migraines, and you get migraines too often to do all of the daily duties that you have, or you have chronic fatigue, or some kind of medical issue comes up. It's not always like you got in a car crash and you can't walk.
Yeah. So the costs of a group long-term disability plan are far less, and there's generally no underwriting. So it's a great place to secure long-term disability. It's commonly overlooked. I tell every single client, max it out.
Yeah.
Max it unless it's unusual for me not to suggest maxing it out. Like maybe if you're on the cusp of retirement and you're fully funded your retirement, like you could retire at any point in time. Hey, you don't need disability. You're good. You've achieved
Right.
you've achieved financial freedom. But
There's a
most
term for that. It's
Mhm.
I actually, one of my students a few years ago taught me
Mhm.
this today. My student worked for I'll just say a very large insurance company that employs lots of interns that are like 22 years old and asks them to call all their friends. They use the term, there's two stages. There's income dependent, right? Where you are still like your financial success is still dependent on your future income.
Yes.
And then there's wealth dependent,
Okay.
where like your financial success is now not as dependent on your income as and that has a lot to do with both life and disability insurance, because
Mhm.
once you have enough money to afford the things that you want to afford both now and in the future, you don't need to insure the risks of not having that income.
Yeah. So wealth dependent is the status everybody wants, but I think that for the vast majority of people that are employed, they're income dependent. So definitely enroll in long term disability. I would also say that it's a no brainer to have you enroll in your 401k. It's amazing to me how
Yeah, of
many
course.
people don't enroll in their 401k. And even if you're like, well, my 401k doesn't, my employer doesn't match my 401k. It's like, okay, so you're just going to abdicate your responsibility to save.
Yeah, and I
So
almost
that,
didn't put that in. I
yeah,
almost wasn't thinking about 401k in this, because it's like you can, generally speaking, you can enroll in your 401k, or
at
you
any
can
time, there's
update
no
it
open enrollment.
anytime.
Mhm.
Right. And so, it's common knowledge, and I think we're okay putting this out on this, that you should be contributing at least to your match. Like get all the company free money in your 401k plan and know what your match is.
Well, because if you don't do that, you're just giving away. I mean, you're literally just not. You're leaving money on the table that you never can get back. But I take it a step further. I mean, that's kind of like bare minimum, because if you're not doing that, then you know it's just not smart. You know, I'm not going to say it's stupid, because there's a lot of good reasons why nobody would do that. But I would say it's definitely not a good idea to not contribute at least to your company's match. But really, is it the best? No, I tell everybody that, in my opinion, the minimum you should be putting in your 401k is generally 10%.
See, I have differing feelings.
Well, I'll be interested to hear that, but I think you should have 10% of your income going to retirement, ideally 15. 15 should be what you have saving for retirement on a regular basis. And idea a 401k is ideal because it's payroll deducted. It's kind of out of sight, out of mind. It's on autopilot. It just makes the whole process super easy. What's your take on that?
Well, I have this take, maybe cynically so, because of the years I spent at Fidelity behind the company benefits. So if you called in and you wanted to like cash out your entire 401k, I was the person you talked to.
Yeah.
So I did a lot of like consulting people on how to more effectively cash out their retirement accounts. And my belief is that if you contribute to your retirement in a way that's unsustainable, meaning that you put 10 or 15% into your retirement, but you don't take care of the fact that you need an emergency savings outside of your retirement account. You don't take care of the fact that you need to have money aside for other goals that you have, right? If you contribute to your 401k, but ignore what's going on outside of the 401k, what ends up happening is that you run into a situation and the 401k is the only money that's really accessible, right? And it's not very accessible. So without getting into all the rules, if you haven't left your company and if the money that's in your 401ks come from that company, only way you're touching it is with a loan. And these loans are terrible because everybody thinks, you used to get all these calls and they say, but I'm paying myself the interest. And it's like, yes, but your money's not invested.
Yeah.
And a majority of the time, I mean, the cost of having your money out of the market. And then not to mention, if you were in a spot where you needed a 401k loan, my guess is your budget wasn't in a great place to start with. And now you've got a loan payment being made on a 401k that's coming out from your paycheck with no choice. So like, how is that supposed to put you in a position where you have financial stability and not kind of push you further into financial stress, right? So to me, there's kind of a savings hierarchy here. Step one is contribute to your 401k company match. Step two, and this is something we haven't talked about yet because we haven't gotten into the medical benefits as much here because they're...
Well, I think we should go into that next.
Yeah, and we will. But step two is your HSA. If you have access to an HSA, before you put an extra dollar above your 401k match, you should be using your HSA. You should be putting the money in the HSA. It is a bigger tax advantage than the 401k plan, right? So that's step two. And if I broke it down a little further, put enough money in your HSA to know that you're covering what you're going to spend on medical if you don't have money outside beyond that. Then go to emergency savings. Once your emergency savings is in place, then you can have a whole lot of other conversations about, do you max out your retirement account? Do you save money outside of retirement accounts? And I think all of those are really, really good conversations. But I think the advice of put 10 to 15% of your retirement in a vacuum is kind of, it can lead people to be, the people that I talk to that are most financially frustrated have like decent net worths. Like they're maybe worth $1 million or $2 million on paper, but all of their money is in home equity in a retirement account. And if they don't have any money in their savings account, if they're paycheck to paycheck, I don't care how much money you're worth on your balance sheet, you're going to feel broke.
Yes.
And that nobody wants that feeling. So our job, I think, as advisors is to help proactively position you so you don't have to feel so broke.
Yeah. No, I think that's a great take. We don't need to elaborate on that. So I think that's a good template to follow.
It's just maybe not as easy as like a cookie cutter, Fidelity comes out and says, hey, starting at 25, you need to put 10 to 15% in your retirement account. And
my suggestion of 10 to 15% is much more, it's oversimplified. I think that's your point, is it's too simplified. But sometimes some people need that level of simplification. But I think that that's a great topic to dive in down the road. But I think for now, the listener should take away your advice there, because I think it's more specific, it's more refined. So we do.
It doesn't take away from the fact that you should be saving 15% towards retirement over time.
Yes.
What it changes is like, well, that 15% towards retirement doesn't all have to be in a 401k plan.
Correct. Yeah. Incorporating the HSA is fantastic.
And
advice.
even taxable accounts or Roth IRAs or whatever, 529s, right?
Yeah. Well,
529 is not really retirement, but you get the
now
point.
We're getting outside of corporate company benefits. I think we've already agreed on this, where taxable brokerage accounts are kind of an unsung hero. They really are fantastic savings vehicles that are underutilized, but they have nothing to do with your employer. So when one of the biggest choices that our clients are facing when they are doing open enrollment is health insurance. So, a lot of times people hear the term high deductible and they see high, and that's where the reading stops. So I don't care about the rest. I don't want anything high. I can't afford that in my budget. But high deductible plan does not necessarily mean higher cost plan. Sometimes when you look at the lower premium amounts and you combine that, the differential between the premium amounts, and you plug that into the HSA, add the employer HSA contribution on top of that, you actually end up with a lower cost insurance policy, especially if you don't heavily utilize your health insurance throughout the year. So, I think that it is important that every single person just break down the cost. Don't just automatically choose the health insurance plan that you had last year. Look at the high deductible versus the copay policy. What do you commonly see these days? Do you even see like the traditional copay policies anymore as benefits?
Yeah, there's typically like a PPO and then a high deductible plan. And like you said, the most common mistake is people see the high deductible, they just assume it's more expensive.
Yeah, and they move on. Yeah, but if you don't choose the high deductible, so not everybody can contribute to an HSA. As you said, the HSA is more tax advantaged than even a 401k plan. It's triple tax advantaged. You got a tax deductible contribution, tax deferral, and tax-free withdrawals for qualified distributions.
Goes in without paying the tax, grows without paying the tax, comes out without paying the tax.
No other account does that. Not even the Roth IRA. It's literally the way every account should be. But we have to pay taxes. It's a certainty in life. So this is the one account that the government literally says we've removed all taxes, so long as if your expenses are qualified. The withdrawals are qualified. So you cannot contribute to this account unless you have a high deductible plan. It is not income dependent like IRAs.
Yeah, you can make as much money as you, as they pay
Elon
you.
Musk could put contributions.
But you have to be on a medical plan that is in
high
line.
deductible. Yeah,
and it's not even just, to get it a little further, it's like specific high deductible. So if your employer participates in an HSA eligible plan, they will let you know.
Yes.
That as you go through the enrollment, you'll see the HSA option. And
I have yet to see a self-proclaimed like high deductible plan offered by an employer that did not allow an HSA.
I've seen it.
You have seen it?
I see
That's
it.
a bit unusual though.
I thought it was super weird. Yeah, but I have seen it.
I think it was an HR oversight. Had to be. I can't imagine.
We ended up sending an email to HR to clarify that there wasn't eligible for an HSA.
Yeah, and what's that all about?
Yeah, very strange.
But the high deductible plans are oftentimes, even if you do have you commonly use your health insurance plan, you still should do a cost analysis on it. Just the ability to add to that HSA is super valuable, and people discount it too much.
Well, and it can save. The savings here can be pretty significant. I pretty routinely see, let's say, $2,000 to $5,000 a year in terms of like net cost difference between selecting, and it's more than just your high deductible or low deductible. It's like when you have a spouse, if the spouse has a job, now you have Do we go on his plan, her plan, spouse A, spouse B, and where do we put the kids if there's kids involved? And, and then sometimes companies say, oh, well, if your spouse has access to other insurance, then there's going to be an extra charge for this. It's another kind of got you where people see that there's an extra charge. And so they go, oh, I don't want to pay extra money. And so they just opt out and tell their spouse to go on their own coverage. The problem is there are times where you might actually be better off even going ahead and paying the penalty for having the spouse that had access to their own insurance.
Yeah. Yeah. So what are some other common benefits? So I do have a question that I thought of. Can you do the flexible spending account for childcare and the HSA at the same time?
Yeah, you just can't do the like full purpose medical.
The Archer medical savings.
Yeah, you could do like a limited purpose FSA, which is a smaller dollar amount. But besides the point, but you can do so if you're thinking about being a W-2 employee, a lot of W-2 people get mad about business owners and our ability to take deductions. But like there's a lot of deductions that are available to you as a W-2 employee. If you think about between like a 401k that's available to you, some of these savings, health savings, flexible spending accounts, dependent care FSAs, you have set like life insurance or medical insurance, dental insurance. All of that is all tax deductible in your paycheck. It just doesn't even hit your income.
Yeah.
So if you work with the right professionals and you have two spouses that are earning, income, you can actually defer pretty significant chunks of money pre-tax using these levers.
Yeah. But the flexible spending account, it's use it or lose it, right?
Yes. Yeah. With the, and it's so funny, right? Because there's so many different things that apply for the, I remember when I left UPS, I had to clear it out because it was a use it or lose it, but it was the limited purpose FSA. So it's only $500. It was a small amount of money and you could roll it over year to year. So I just never used it really. And I left UBS and I needed to use it. So I went and have you ever heard of Supergoop sunblock?
No.
This is like the bougiest sunblock that you could ever buy. It's I think it's like $40 for some little tiny tube of it or whatever. But I am I guess we don't have the video going today, but I am what they call pasty. And so I'm prone to sunburn. So I need some good sunblock.
You need Supergoop.
I dumped every bit of that FSA on
$500 sunblock. Holy moly!
Well, we still actually use.
Hey, that might be a great tip of the day. I mean, was it good? Did it work?
I love that sunblock. Yeah, they have one called Unseen Sunscreen.
Yeah,
and it's like it's not oily, So it's like I think it's technically like foundation for like makeup. Like it's like it's clear and whatever, and it's SPF, but it's like. It's very, it's not oily at all. So it's just very like, I hate oily sunblock. There's just nothing worse than putting this, oily, greasy stuff on. So this is just very like not oily, blends into your skin. It's great. So Unseen Sunscreen.
So there you have it. If
great.
You got an FSA with a balance and you have no purpose for it,
save yourself some UVA and UVB
Supergoop.
rays.
Was it Supergoop?
Supergoop.
Supergoop. There you go. There's your idea.
Not sponsored.
So I wish it were. By the way, we're not turning down sponsors. So if you happen to be listening and you work for Supergoop, give me a call.
I don't need a sponsor.
So, just to recap, we're thinking, double check do a cost analysis between, regular health insurance and a high deductible plan. The FSA especially for childcare. Is a fantastic option. HSA, if you have a high deductible plan, long-term disability, legal services. Can you think of anything else that people should be looking at?
Yeah, you mentioned those short-term benefits.
Yeah,
like it's like I kind of laugh at. It's like the ones where like if you get your arm cut off, the accidental death and disability coverage. And you had asked earlier in the podcast what you thought, what I thought about that, and I kind of agree with you. If you're paycheck to paycheck, you may want some of that stuff, but if you have a proper financial plan and you have enough liquidity and savings and retirement assets, you're not buying insurance for the things that cost you, $10,000 or $20,000 or even $50,000. You're
Mhm.
buying insurance for the $1 million
Yeah, the
holes,
catastrophic
the
losses.
catastrophic
Yeah.
stuff. So really, when we think about, you know, okay, would you like an extra $50,000 if you got cancer? I'm not saying that that's bad, and
Mhm.
you can elect it if you want, but that won't. If that is the deciding factor between your financial success or not,
Mhm.
there's probably bigger conversations to be having.
Yeah. So, I think with that, we can definitely help people address these open enrollment questions. So if you happen to be reviewing your open enrollment options right now and you're uncertain, which one should I do, or you're just reacting and you're like, I don't have time to analyze this stuff. I don't think, uh, I don't think I'm going to change anything because, I don't see the need to do it, but you still are curious. Like what are some of the options that your employer is giving you that you may not be taking advantage of? Just, give Brent or myself a call. Our information is in the show notes. We love to geek out on this stuff.
Well, and if if maybe a call is a little bit too, you don't you want to kind of keep a little bit more to yourself. What we'll do is I have a checklist on annual employer benefits review, and we will include a link to this checklist in the show notes. And if you want to just go through, it's essentially a series of questions, yes or no, relevant to you, and it will generate a report that we can follow up with if you'd like, and it will also uh, get if you answer yes to a question, it'll tell you, what that yes means and where you might want to go from there.
So I think we want to move on to like some listener comments. That's one thing we're trying to gravitate towards. By the way, Brent and I have an email address that we monitor regularly called comments at themoneyalchemistpodcast.com. Let me double check that. I'll put it in the it's a relatively new email. So we'll want to make sure that I get it right here. So it's comments.
Comments at moneyalchemistshow.com.
Yeah. Okay. There you go. So comments at moneyalchemistshow.com. Again, I'll put it in the show notes. So we can get listener questions and feedback from that sent to that email address. And we do get listener questions. Now, here's the rule. Unless you state that you want your name stated, we're just going to keep our keep everyone anonymous. That way, it's a safe environment for people to, ask personal questions about themselves. So unless you explicitly state that you want your name shared, we're not going to share it. So we do have a listener question that we want to throw up to the two planners here, and we challenge you too to try to stump us. We've seen a lot of different things in our careers, and we're always looking for like interesting scenarios that we've never seen before, novel scenarios, and we do run into these from time to time, but they're not as common as they used to be. But the listener question was, Brent, we're buying a new home. What do we do with our old home? Should we rent it out or sell it to fund goals or reduce the mortgage balance on the new home? So the idea is, should they use this transition from one home to the other as an opportunity to become landlords and get into real estate investing?
Well, I know you and I will have slightly different opinions on this.
Yes.
So what do you think? You go first.
I think we both agree that it's generally not a good idea to like focus and go into becoming a landlord when when the perception is it's just passive income. So I think it makes sense to go into real estate as an investor intentionally. So if you have a business plan and you're planning on doing it in some capacity full time, or the expectation that, hey, this is going to be like a big component of my life, then it may make sense. We just got to make sure that the numbers and the plan look good and look appropriate, that they're aligned with your expectations. That said, most people don't do that. What most people are doing is they're reading articles, they're hearing about friends and Instagram posts and Facebook posts about, oh, this Verbo changed my life. How do you say that, by the way? Is it VRBO? Is it Verbo? Yeah. So that one of the big trends right now is short term rentals. that's been a trend for some time. And, I've also seen some nightmare scenarios out of that too. But there's absolutely nothing easy or passive about real estate investing. So if the objective is we're just trying to make the most possible money we can, but still not spend any more money than we currently are, then I'd say you're crazy. That's not going to happen. You need to sell the house. By the way, I just did this. I had that option. I could have rented. I'm in the money business. I know what the returns are, but I also know what I want my time to look like. I don't want to devote a single second to trying to find a new tenant, to repairing some sort of uh, problem on a house. I've got a hard enough time trying to repair the problems in my existing house, let alone a second one. So, then I would have had to farm it out to like a property manager. Well, then let's look at the return profile of that. Now I'm making less money than if I just put it into a mutual fund or an exchange traded fund. So it's just, to me, the numbers don't add up. If you want to do it passively, but if you're wanting to do it as a stair step to like building a like real estate empire, yeah, it could make sense. So where you and I think disagree a little bit is on the notion of taking the home equity and applying it to the new mortgage to reduce the balance, or if you should use it to pad your liquidity.
Yeah, and we did a podcast on this. Oh
Mhm.
gosh, it's probably been a year now.
Yeah.
Um,
Liquidity versus equity trade-off for those who want to look it up.
yeah.
Mhm.
So it was so funny that we got this question because this is one of the more common over the last 4 years.
Mhm.
This is just such a common issue
Yes.
that people face, because what's happened is people that bought houses 4+ years ago have
Mhm.
these just awesome interest rates, 2.75% or something like that, 3%. And
They don't want to give it
they
up.
don't want to give it up.
Yeah.
So I've for a long time now, I've had this theory that I call the great capitulation.
Mhm.
And it's effectively like the slow but inevitable, like, honey, we need more space, right? Or we need like this, like inevitable. There's statistics that say you move every 7 years. You don't move every 7 years because you get bored of your house. You move every 7 years because your life changes,
Mhm.
right? And as your life changes, the house doesn't fit your needs anymore, and so you make shifts. Well, now you've had people that have these houses that have low interest rates, and their lives have changed. It's been at least 4 years,
Yeah.
since you bought this house, but probably longer than that on average. And so people's lives have changed. They're reluctant to want to get out of their existing house, but it's inevitable that they're either going to need to sell it and buy a new house, or they'll need to renovate it in some way to meet their goals,
Mhm.
right? And so then you buy this new house, or you do a renovation, whatever, but you end up with this new mortgage. It's like 6%, and your old mortgage is at 3%.
Yes.
And you're thinking, I've read financial books before, and they say real estate, passive income, financial freedom, right? And so we get the call, hey Brent, hey Ben, what do I do with the old house? And what do you think? And we're thinking about renting it, and what do you think? And I kind of agree with you in the sense, like, I fundamentally agree with your assessment that if you, like, I work with a lot of people that are in sales or they're in, management, or they own their own business. And they, real estate isn't their core competency.
Mhm.
There's something that is their core competency. They make a lot of money doing, and they have a lot of growth potential in what they do, but it's not real estate.
Mhm.
And so is the real estate an enhancement to your wealth, or is it a distraction? Right. And I would argue, one of the things I think is so controversial about young people is, like, we spend so much time trying to get out of what it is that we actually do. Like,
What it is that we want our parents' wealth.
Well, and
we
you'll
see,
get it if you're patient and let the money grow. Like, I mean, don't get so eager and ahead of yourself. My point is that, people get good at something. They find a job, they're making good money doing the job. And then it's
Mhm.
like, they're spending their entire time trying to figure out how to not do that. And it's like, but wait a second, you are really good at doing this. And that's where you make a lot of money.
Yeah.
So let's try to focus your time and energy there, and get rid of things that
Correct.
distract from that. Now, okay.
But what that requires you is to reconcile the reality that this is not a get rich quick scheme. I think what happens is when people want to buy rental properties or invest in rental properties, there's this idea that they're supercharging their net worth growth.
Right.
I think it's perceived incorrectly that it is it's like super fuel on asset acquisition because you're just using leverage. That's what
Right.
it is. People
Yeah,
are
using we call it OPM.
yeah, other
Other
people's money.
people's money.
So and they fixate on the asset side of their balance sheet. They say, "Oh, look, we got these two properties. Look at all this what these properties are worth." Meanwhile, they don't pay attention to the debt side and then the risk that potentially that the risk of that potential there where what happens if you lose a job or the economy, the housing market collapses, which I doubt will happen, but it's possible. So you're increasing the risk of your overall the sensitivity of your financial position, but also what you're doing is you're not paying attention to the costs. That's what people do.
Yeah, that's the hard part. You get gross rents, and then you have like your
Oh
mortgage
my
that
God.
you pay, and then
Brent, one of the most frustrating things conversations I have is when I talk with someone who does rental properties and they don't factor in the value of their time. They completely discount the value of your time. So I'm like, let me get this straight. So you have a full-time job, right? Yes. Okay. What's the dollar per hour that you make from that? Oh, it's X amount of dollars, and it's usually not an insignificant amount. It's like, okay, so that is the value of your time. Why do you think your time is worth $0?
yeah.
Yeah,
I mean,
so
so, like the point is like your time, like you spend your time on things that have
Mhm.
high value to
Mhm.
you, and things that you're best at are generally going to have high value. And it's just, it's kind of an unfortunate truth that you are generally going to like at the beginning of wealth creation, like when you're in the accumulation stages
Mhm.
of wealth building, income is the number one driver,
Mhm.
right? Like there. I can show you. I mean, I could show you the best investment in the world. If I am, ever omniscient, and I know Nvidia is going to go, up 6,000% in a few years, and we put, $10,000 in it, you may make some decent money, but it's not going to change. Like it's not going to be enough money for you to just retire and ride off into the sunset, and then you don't have any purpose. So it's better spent trying to implement, like you said, get rich slow methodology. But let's get back to the
Or
question at hand.
get rich smart. Yeah.
Yeah. Well, I say slow, but I would say that, anybody that's, got any level of gray hair knows that time always looks like it's going to take a long time when you look out in the future. And then when you look backwards, it's amazing how fast
Yeah,
it
it
goes,
goes
right?
real
So,
fast.
but back to the question, I think, and this is what I really want to drive on it, because this is the biggest mistake that you can make in terms of getting out of a personal residence and holding onto it as a rental.
Mhm.
Is that there is a rule in our tax code that allows you to take gains
Mhm.
on personal residences tax free.
Yes.
Now it's limited. If you're single, it's 250,000. If you're married, it's 500,000. But if your tax rate on those kinds of gains is 20%,
Mhm.
and you've made $300,000 on a house, let's say you bought a house in 2017, 2018, 2020, something like that, and it's gone up by a few $100,000. Now you're moving into a new house and you sell it today. It falls under the personal residence rules that the IRS has, and you don't have to pay taxes on that appreciation
Mhm. Up to that exemption amount.
up to that
Mhm.
250 or 500. Now, if you rent it out, you don't immediately lose that benefit. If you start renting it, you basically have a 3-year clock.
Yep.
The way the rule works is that you
Mhm.
have to have lived in the house and used the house for 2 of the past 5 years.
Mhm.
So basically, once 3 years goes by, you're no longer 2 of the last 5. And all of a sudden, that whole gain goes from being tax-free
To taxable.
to taxable.
Yep.
And for a lot of our clients, their tax rate on this money is like, let's just ballpark it at about 20%.
Mhm.
So when you look at how much incremental tax you're going to owe on a $300,000 gain, you're talking about an extra $60,000
Yeah.
of federal taxes.
And there goes your rental income.
Over 3 years.
There goes your
We're
rental
talking
income.
$20,000 a year of taxes. So back to your, I wanted to pick on that because you had kind of said, well, if you want to build a rental empire, then maybe do this. I would argue that even if you want to build a rental empire, you really want to be careful because you may.
Well, you want to sell that. If you're going to do this, look, I don't, this is not a full blown episode on how to construct a rental business or a real estate business, but you should not be doing it as a sole prop. So in this example, if this couple wanted to do this, what they need to do is sell the property to an LLC that they wholly own. And then that would reset the cost basis. So then they would not fall into that tax issue, and they would have the limited liability that you really need to have if you're running a rental property. But here's the catch:
you're not going to keep your mortgage.
They're going to have to refinance. Yep.
Yeah, you're gonna be back to your 6% mortgage.
What they're trying to do is they're trying to get cute, and I don't think it's going to really work out. And I don't recommend it. Now, if you do want to seriously become a real estate investor, and this is something that you are passionate about, and I know we have a lot of clients, we work with a lot of clients that are very talented real estate professionals. They make good money. It's a great career, but it should never be. I think it's a mistake to treat it as like a lucrative passive side gig. Name me one person that does this that's like a part-time landlord that isn't constantly stressed out by it.
Yeah, I mean, I've dealt with this situation a lot, and I have yet to run into one where it's like a really positive experience.
And it's really tough to unwind. So because what happens, what people also do is they get into this because they want the tax deduction through the depreciation. So, and people jump all over that as soon as they can. They even do like cost segregation studies, and they pack in as much depreciation as they can. Depreciation works really well if you die with the asset, because you get the step up in basis. But if you try to unwind this stuff, now you're going to be like pulling all this taxable income into 1 year just to unwind the thing. And it can be very painful. So you definitely want to be super intentional about becoming a real estate investor. Now, real quick, because I know we're running a little over here, but do you think that they should take that equity and pocket it? Or do you think that they should pay down the mortgage?
You know my argument here. This is where you and I are slightly different. And, if I was to bundle my belief into kind of a short snippet, my belief is that you are better off with a slightly higher mortgage payment, but more money in investments and savings outside of a retirement account. So rough math, if $100,000 extra down on your house means that your mortgage is going to be $500 a month cheaper, I would rather have that $100,000 in an investment account or in a savings account or a combination of, because to me, I can make a lot of $500 a month payments with that $100,000. And that gives me a lot of financial security, knowing that I can use that money on my balance sheet to keep things floating, versus if I put the extra $100,000 down on my house, and that means that I don't have any money in my savings account and I lose my job or something happens, the mortgage company is still asking for their monthly payment, even though it's $500 less. And I still don't have the money in my bank account.
I think your argument makes a lot of sense for anyone who has the discipline to maintain the liquidity.
And that was my point, is that your argument of, if you put the money down in the house, like once the money's in the house, you're not getting it back out. So it's forced savings. And if you can't be trusted to handle a large sum of money in your investment account on your own, then I guess I'll pat you on the head and tell you to put it in your house.
So for this, the question, we're going to throw a question back at the listener here. How can you trust yourself with that amount of liquidity? That'll determine if you should apply it to the mortgage, or if you should apply it to, or put it into a taxable brokerage account.
And I think this is a selfish plug for financial advisors, because if you put that money into a brokerage account that it's just you and nobody else really knows what you're doing with it, and it's just
no accountability
all on you. There's no accountability. If you have a financial advisor and you run a financial plan and you say, okay, we sold our house, we're going to take this extra $100,000, we're going to plug it into an investment account, we're going to invest it, we're going to go along with the plan. You kind of have to answer to the advisor or to somebody else if you derail that. And I think having that little bit of friction there can be really useful.
Yeah, absolutely. So great way to tie up that question. And that we're going to add one last thing. Every show, we're going to end the show to keep you listening all the way to the end, a tip of the week. So this week we got a tip of the week. We're going to try to make these kind of fun consumer reports like inspired. So I wish I had a tip of the week around how to make cameras work better because our video is going to come back the next episode. This week we ran into some camera difficulties, so it's audio only for this episode. But Brent, go ahead and let everybody know what the tip of the week is.
Why is your tip of the week? Why do I?
Yeah,
get to
actually, I
announce
did
it?
come up with it, so I'll go ahead and release it. All right, so this tip of the week is don't spend your HSA contributions. Leave them put. So what most people do is they put money in the HSA and then they turn around and they spend it on healthcare in the same year. Don't do that. What you want to do is contribute to the HSA, invest it, and then spend your cash flow. Spend your cash flow.
Yeah. So
on
assuming
the
you
health needs.
have the means to do so and you can kind of stay financially stable in doing this.
Yes.
When you put your 4,500 roughly single and like eight or 9,000 for
it's
family.
$8,350 for family contribution, $4,150, I think. No. It's I'm sorry, $4,250. It's $50
Regardless.
less for the family. $4,200. I'm sorry. So
regardless, so when we are working with our clients, we generally advise them to put their money in their HSA, max it out, and as long as they have the means to leave it in there and still pay for their medical expenses, we'll invest the HSA money and not touch it. And the reason for that, if you think about it this way, this is how simple compounding, right? If you make, let's just say 10% per year in your investments, and you have $5,000 in your HSA, 10% a year is $500.
yes.
$500 isn't going to go a very long way in your medical costs in the grand scheme of things. So $5,000 in your HSA, somewhat unproductive. On the other hand, if you have $50,000, now all of a sudden 10% is $5,000. If you look at a lot of medical plans, a lot of high deductible plans, they have generally about a $6,000 deductible, right? So once you start to get to $50,000 or $60,000 in your HSA, the earnings every year are earning enough money on average
pay for the deductible.
to pay for the deductible. And when I work with a lot of the clients that when we work with our clients on the math on this, it more or less works out that, and a lot of assumptions go into this, right? So we look at a healthcare calculator to figure out how much money you'll need for healthcare retirement. And, you have to assume how much can you contribute to an HSA every year and all this other stuff. But generally, when my clients get to somewhere between like 50,000 and 70,000 in the HSA, we flip that switch.
Yes.
We go from contributing to the HSA and not using the money to contributing to the HSA. You still want to get the tax deduction for the contribution, but now every medical expense that you have comes out of that HSA.
Yeah.
And basically the setup is that now the hope and the plan and the way that it's maths out is that by the time you get to retirement, you will actually have enough money in that HSA to continue to fund your medical expenses through retirement, tax free.
Yeah, bingo. So you're taking maximum advantage of the tax deferral that you get.
If all you do with the HSA is put the money in and then yank it right back out, the only real wealth benefit is the little bit of tax money that you're saving.
Yeah, you're getting the tax deduction. That's about it.
The way that we plan for HSAs, you're saving clients hundreds of thousands, possibly in the seven figures of taxes over the course of a lifetime.
So just to recap, tip of the day, don't withdraw from your HSA. Unless
you don't have the means not to.
Here, let me refine this tip. Don't withdraw your HSA contributions in the same year you make them.
Well, I would maybe make it a little different. I would say if you have the means, you should contribute to your HSA and invest those contributions and leave them alone until there's a large enough balance in the HSA to do otherwise.
See, you should have given the tip. You made me give the tip and I botched it. So there you go. That's a perfect way to sum it up. So thank you for listening to episode 43 of the Money Alchemist podcast. And we'll catch you guys next time. All our information is in the show notes. Hopefully you check it out. Opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. Investing involves risks, including the potential loss of principal. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Advisory services offered through National Wealth Management Group, LLC.